Final accounts with adjustments, and this module is also continuity of the earlier two modules in which we are discussing a lengthy question on preparing financial statements with adjustments. So in this module, we will learn how to pass adjusting accounting entries. Okay, so please be attentive as you are always. Okay, well, so first of all, we have to work out depreciation expense for the year, in which we see that there is a table in front of us. In this table, you have furniture, equipment, building, and motor car. These are in fact the four assets which were appearing in the trial balance. I'll advise you to please open your booklets in which that trial balance is appearing. That should be in front of you, please. And also your calculators should be ready. Okay, well, and obviously notepads and the writing device. Okay, well, so the cost at the opening is appearing in the trial balance, or we will be calculating it, which is 25,000 for furniture. For equipment, it is 20,000. For building, it is 30,000. Why 30,000? Because half of the building was used by the proprietor, okay, and half of the building is in our use. And the motor car cost is 30,000. We have already discussed this thing while reading the trial balance. During the year, we had addition of 4,000 in equipment. And by the way, this 30,000, although we are putting in the opening cost, it is addition during the year. Why we put over here? Because this is something on which we will be taking full year depreciation. Okay, because the date of purchase is not given. We are assuming that on the opening date this was purchased. Well, so deletion in the adjustment, if you will see the first adjustment in which furniture having cost of 1,400 was disposed of. So the closing balance of the cost of furniture is 23,600 with us, and equipment is 24,000. Since we have purchased this 4,000, equipment is 24,000. Building is 30,000 with us, and motor car is 35,000. What we did, that there is an addition of 10,000 of motor car and disposal of 5,000 of motor car. So ultimately we have 35,000 of the motor car with us. Accumulated depreciation, opening balance 36,000, 4,000 and 10,000. This is what we took from the trial balance. Okay, the accumulated depreciation of the motor car is 5,000 because it was fully depreciated, mentioned in the adjustment. It was fully depreciated. So 5,000 cost and 5,000 accumulated depreciation. Cost will be subtracted from the cost, and accumulated depreciation will be subtracted from the opening balance of accumulated depreciation. And this is important. Now we will calculate depreciation expense for the year. 2,000 for furniture, 3,600 for equipment at the rate 10% reducing balance method, 15% straight line method, 5% reducing balance method, and 20% reducing balance method. This is the depreciation charge for the year for which depreciation expense will be debited. Okay, and closing balance of accumulated depreciation is 5,600, 7,600, 1,500 and 11,000 respectively for furniture, equipment, building and motor car. And the net book value which will be finally appearing in the balance sheet, 18,000, 16,400, 28,500 and 24,000. So this is the depreciation schedule with us. Its working we will be discussing in the upcoming section. So the accounting entry that we will be passing for this is depreciation expense debit and accumulated depreciation for each asset credit. If you see, This 2,000, 3,600, 1,500 and 6,000 is the same that we had over here. Okay, so this depreciation expense for the year would be taken from this schedule, from this table, and will be placed in this depreciation accounting entry. Depreciation expense will be debited and accumulated depreciation or provision for depreciation will be credited. Okay, and please don't forget to mark ILO. Okay, so these are contra to asset, minus A, minus A, minus A, and this is expense E. Well, then we sold out a furniture item during the year, for which we had an error that was credited to the sale account, so which was wrong. So that should have been credited to the furniture account. So furniture account credit and the sales account will be debited. So when we are debiting the sale account, it will cause a decrease in income. Okay, minus I, and furniture credit means it will cause decrease in asset. Then we purchased office equipment, which was wrongly debited to the purchases account. So now purchases account will be credited, which will be subtracted from the expense, minus E, and office equipment will be debited. This is in fact because of the wrong decision we took for recognizing the correct head and based on capital and revenue expenditure concept. It was in fact the capital expenditure that was wrongly taken as revenue expenditure. So now corrected. Well, the next thing is that motor car debit and creditors for motor car credit. This is something that we purchased during the year on credit. So there is a liability with us, and motor car, there is increase in assets. Then there is a sales accounting entry, or in a way asset disposal thing, in which motor car, which was having 5,000 cost and which was fully depreciated, is being sold out. So what happens that its profit is 1,000, okay, because that was sold for 1,000. And there was an error, if you read that adjustment, that this 1,000 was wrongly credited to the sales account. Although that has been accounted for correctly in the cash account, but was wrongly credited to the sales account. So now we have to debit the sales account, which will decrease our income. We have to debit accumulated depreciation, which will reduce our accumulated depreciation, as we see in the table as well of depreciation calculation. And motor car will also be credited. It will reduce our motor car assets. This is also what we have seen in the table for depreciation. And profit on disposal of motor car will be credited. This is our income. Okay, it will be appearing in our income statement as other income. Then comes second adjustment, which is about the closing stock. And we know that closing stock is our asset because this is the purchased goods which remained unsold. So purchased goods which remained unsold are assets and should be debited and should be taken out from the cost of goods sold. Why? Because we have added all the purchases in the cost of goods sold. Therefore, now we have to reduce cost of goods sold with the amount of closing stock. Got it? So closing stock debit and cost of goods sold credit, 44,000. Next comes outstanding rent for go down for 1 month, which is in fact 500. How we calculated this 500? Because 5,500 is given and it is representing 11 months. Since it is representing 11 months, so the 12th month 500 is due, which we have to pay. So it is an outstanding expense which will be debited to the rent for go down as an expense debit 500 E, and rent payable is our liability which is being credited to the rent payable owing. Okay. Next comes outstanding salaries for 1 month. Again, salaries paid during the year 11,000, representing 11 months. 1 month's salary is due, so that 1 month is equal to 1,000. Salaries as an expense debit and salaries payable as liability credit 1,000. Okay, so all these two accounting entries were pretty much easy, but logical calculation is required to work out 1 month expense which is still payable, okay, in these both cases. Then comes interest on loan. If you do remember, 2,700 interest on loan was already appearing in the debit side of the trial balance, interest on loan paid to Bhutta. When we calculate this interest, it comes to 3,300. How? The total amount of loan is 30,000. The interest on loan is 12%. The total amount of interest is equal to 3,600. But in the adjustment, it was written that the loan was taken 1 month after the start of the year. So if it is so, then it means we are obliged to pay interest on loan equal to 11 months. Whereas this 12% is the rate per annum. Per annum means for 1 year. So 30,000 multiplied by 12% gives us 3,600 amount of interest, which is for complete 12 months. Whereas in this year, the interest on loan obliged on us, for which we are obliged to pay, which is our obligation, that is equal to 11 months. So 11 months interest is equal to 3,300, out of which 2,700 amount of interest on loan has already been paid. Appearing in the trial balance means 600 amount of interest on loan is still payable. So that interest on loan that is still payable is our expense, and interest payable is our liability. So this expense will be added in 2,700, which will give us 3,300 in the income statement. And this 600 will be taken to the liability as interest payable. Okay. Then comes adjustment number 6, increase in provision for doubtful debt. And it is very easy that it is written in the adjustment that we have to increase by 1,500. So straight away bad debts debit and provision for doubtful debts credit. Bad debts are expense. It will be taken to the expense straight away. And this will be subtracted from the assets, the debtors. Okay? Yes, this is what we already know. Great. So next comes insurance premium. Insurance premium includes insurance for proprietor, number 1, and then 3 months insurance is prepaid. So the insurance premium that includes the part belonging to the proprietor will be taken out from the insurance premium by giving credit to insurance premium. This is minus E, put minus here. And drawings will be debited. So drawings debit and insurance premium credit. This will be subtracted from insurance premium 4,000 and it will be taken to the drawings. And then insurance prepaid for 3 months. 1,500 is the amount in which is in fact showing us for 15 months. 3 months are paid in advance. So this 3 by 15 will give us 300. This 300 is prepaid insurance, which is our asset. And this insurance premium will be reduced. We have to put minus here. And this 300 is credit in the insurance premium. All right. So what comes next is half of the building purchased during the year is being used by owner for personal use. So it means that building account, which was our asset, appearing in the trial balance equal to 60,000, that will be credited minus A and will be taken to the drawings account minus O, because drawings will be debited and will be subtracted from the owner's equity. That's also fine. And then discount allowed wrongly debited to the discount received account. Discount allowed would be debited and discount received will be credited. Since discount received is being credited, it's an income, it will increase incomes. And discount allowed is being debited, it's an expense, it will increase expenses. All right. So this was all about the adjusting entries relating to our scenario. Now we have to see that what are the ITTRs to this module. And the ITTRs to this module are that for each adjustment there are two accounting effects. Okay. Remember, each adjustment carry two accounting effects. One is debit and the second one is credit. And don't forget to mark ILO, okay, for each adjustment, for each adjusting entry, okay. So thank you very much for your attentions.